All right. Well, as people are filtering in, I've just turned the recording on. And we're going to get started in probably less than a minute here. We'll try to honor the top of the hour. There's usually a burst of people that come in during the first minute or two. So I'll kind of do a little bit of introduction here while we're waiting for the rest of you to file in. I'm joined here tonight by our investor concierge, Josh Beck. Say hi, Josh.
Hello, everyone. How are you?
Good. And Josh will be here taking questions tonight. If you have questions, please put them in the chat window. And when I take breaks in between topics, Josh will ask those questions, and at the end we'll have time for more questions as well. I'm also joined by John Harrison, who's one of our sales representatives, and John, say hello. A lot of you know John.
Hello, everybody. Good seeing all these familiar names here.
Yep. So with that introduction, I think I'm going to get started, and there will be a recording of this. If you registered, I think we send that out automatically. And obviously, if you didn't get it, send an email to either support or John or myself, and we'll try to see that you get it. All right. So let me get to the share screen. And we'll put up the PowerPoint. All right, here we go. Okay, so we're here tonight to go over the 2023 Freedom Energy Funds that we're opening up as of last Friday. The funds are going to be a little bit different this year for a couple of reasons. One is we are doing only pipeline units, which are the larger, more profitable units. And so that is good news. And we are also going to be dealing with the new depreciation rules. So as always, we have the financial disclaimer here. We're basically making forward-looking statements, and all the basic stuff here that everything that we put out is a projection. There's no guarantee of any performance on the pro formas, and I'll let you guys read through this, and I'll give it a minute to look at it, and then we'll move on to the next. So as you know, my company is called Freedom Impact Consulting, and we are now operating over 70 funds with CO2 capture equipment. We are operating with the company CETA, Clean Energy Technology Associates, and that company is run by Roy Hill, who is the CEO and president. I'm basically a retired dentist who got into investing about 6 years ago, and we started Freedom Impact Consulting about 2019, and since then we've raised nearly $240 million toward this carbon capture equipment, and we have over 170 machines in the field. I mentioned Roy. I just say a few words about Roy. Roy has been running CETA for at least 12 years. I think it's a little longer than that now. I think it was 12 years when I met him. But CETA is basically a company that is in the energy space. They are known for their clean energy products. equipment, and we'll get into some of the things that happen at the CETA plant later on in the presentation. So the funds that we run are basically involved in purchasing this carbon dioxide capture equipment. And this equipment is basically used by the large oil companies to scrub CO2 from their natural gas wells. We purchase the equipment and own and operate it through CETA and their lease contracts with the oil companies. So what you see here is one of their backup machines at the plant. This is a Nomad machine, and in one of the future slides, I'll go through and explain what each of these components is. And then we'll also show some pictures later of the large pipeline equipment. And the difference is this is just a smaller volume piece of equipment that hooks up to a 1.5-inch well bore. And the pipeline equipment hooks up to a 9-inch pipeline that feeds from multiple wells. So it's actually more efficient for the pipelines. And I think everybody kind of figured that out this year, that it's a little more efficient to manufacture one type of equipment. And it's also more efficient to put them on the pipelines and process more gas at one time. So that is part of our reason for switching over to all pipelines. Now you can see this is Roy standing next to about 8 of these pieces of equipment that were ready to go out to the field right at the end of the year. The mixing chamber that you see here corresponds, I don't know if you can see my cursor, but it corresponds to this portion of the smaller Nomad units. So that is the large pipeline equipment there. So as you know, what I'll do now is I'll kind of go through how our process works with the equipment. In other words, what happens at the wells, and how does the oil company utilize our equipment, and what is the benefit for them to use it? So what we have is this equipment is mobile. So we can mount this equipment on tractor trailer beds, and we can move it to the wells or the pipelines. And so once the units are hooked up to the pipelines or the wells, the natural gas flows through there, and we use a solvent called CETASolve, and we'll explain where the CETASolve comes from in a minute. The CETASolve is sprayed through the natural gas stream, and as it does that, it pulls more and more CO2 out of the gas, and it basically recycles through until 99% of the gas or the CO2 is removed from the natural gas. And at that point, then the equipment separates the two gases and liquids, and the natural gas is basically clean and available to either sell at there or transport it for sale. The solvent then, which is full of the CO2, is collected, and then it is shipped to other oil wells in the area or gas wells, and it is injected into the oil and gas wells. And in a process called enhanced oil recovery, it works somewhat similar to a fracking operation, in that the kinetic energy of the CO2 and the pressure of the liquid breaks up shale formations, and it increases the productivity of the wells up to 30%. So basically, we're getting absorbed CO2 at the natural gas wells, and then we're transporting that saturated solvent to gas wells, injecting them into the gas wells, and increasing the production of oil and gas in those wells. And then our revenue is derived from the increased oil production on those oil wells. So if the well is producing 100 barrels, and then afterwards it's producing 150 barrels, then we're getting the revenue based on 50 barrels. So we are getting the excess. Now, I recently been told that, you know, and I get the question asked a lot of times is, well, if this is based on oil production, what happens when the prices go way up and way down? And the good news is that we have established a baseline price of $78. And so that is the lowest price that we get for our additional production. And then there's a fluctuation of up to about 10% when the prices go up and when they go down. So we are basically getting paid in a 10% range, hovering just above $78 a barrel. So for that reason, we've kind of got a minimum that we can lose. So if oil's down at $30 or $40 a barrel, we're still getting our number. And so that is why the payments are rarely, you know, greatly up or greatly down as a result of oil prices. So, and it works both ways. I mean, we've had this deal going through, you know, less than $0 oil prices, like negative oil prices, and we've also had it with very high oil prices. So it does go either way. So why do the oil companies like this? Well, for one is they still have to process that natural gas. So if they are pulling natural gas out of a well and they don't have a way to process it on site, then they have to have transport costs and transportation to take that to one of the plants that can clean the CO2 out. So our project actually saves them that money, and then it has the additional advantage of allowing them to use the byproduct of the saturated solvent on their wells. Now, there's two features to that. One is that they are getting they have a way of sequestering the CO2 underground, so that helps their carbon footprint when they're publicizing, you know, how much carbon they're releasing versus storing underground. So that's one advantage to it. They are eligible for monetary carbon credits for storing oil underground. So they have the opportunity to apply for those credits. And then finally, they basically are able to use this liquid instead of fresh water so that they don't have the issues of cleaning the water after an injection process. So those are kind of the green aspects to this project. So. And so where is the demand for this? There's quite a bit of market demand for this in just the Permian Basin of West Texas alone. And I believe that Exxon alone has 1,800 wells and feeder pipelines in the Permian Basin. And we figured that it would take up to 500 machines to meet the demand for all of those wells. And we are also working with several additional oil producers and gas producers outside of that, several of the big ones and several smaller interests as well. We have also had an interest, although we have not deployed any of our current equipment at a hydrogen plant, but we believe that that they will be using some of those units at the hydrogen plant that they're building outside of Houston. They can use it on cleaning the gas coming into the plant because I think they use natural gas to produce the hydrogen, and then also the emissions from the plant can be treated to remove carbon dioxide from the smokestacks and that sort of thing. And then the other cool thing that looks like it's going to happen is that a combination of CETA's CETA's coal distillation and the carbon dioxide scrubbers are used for a coal plant and a coal mine on the Texas-Louisiana border. And they've done some testing and they believe that they can operate that coal plant, which was doomed to be shut down because it couldn't meet regulations. But with the clean coal from the coal distillation units and scrubbing on the emissions, they believe they can operate that plant inside of regulations. So that could mean a turnaround for the whole coal industry. So our demand for this is only getting better and better. All right, so I'm going to pause now. I'm going to talk a little bit about the equipment, but I'll take a pause if there's any questions in the chat. Josh, can you tell me if there's any questions in there? And
Yeah,
if not,
absolutely.
okay.
I'm gonna go ahead and just mash up a couple questions because they're
Yeah,
basically
yeah,
asking the same thing.
yeah, that's fine.
So folks want to know if they can invest in a EQRP or a solo 401k or some sort of benefit plan in either the leveraged or the non-leveraged funds.
I can discuss that. I was actually probably going to discuss that a little bit later, but the answer is that because this is an active business interest, you will be taxed at the UBIT rate for anything inside an IRA. And that is true of a QRP too, although they say that UBIT doesn't usually apply to the QRPs. That is true for leverage, but the reason this is being charged a UBIT tax is not because of leverage, it's because it is a business, it's an active business. According to our accountant, Tim Gertz, he said that, IRA accounts were generally not designed to operate businesses, and that UBIT tax is pretty penal. It starts at 0 to 12,000, gets you to 37% within 12 grand of your first profits. And so while we have a fund in place that was kind of designed to accept IRA type funds, it is nowhere near the performance of the other funds that we do. And we really don't have that fund available for the pipeline units because, we set that fund up for the Nomad equipment. And we just haven't had a big demand for that. So my recommendation is I would not use IRA funds because you're wasting a great benefit. I think there's better money to be used for those.
Great, thanks for answering that. Here's a question that intrigues me a little bit, and I'm sure other people are curious about this as well. Do you already have purchase orders or lease contracts in place by the oil companies prior to raising capital from investors? And therefore, the investor capital is being utilized to fulfill the lease contracts? And then is there any risk in not being able to secure contracts with the oil companies for these machines?
That does not appear to be the problem. Basically, when we started this process, Exxon was ready to accept 500 machines from us as we could bring them out. The reason we haven't brought them out, real quickly is we're basically ramping up the business, and trying to scale it up so that we can maintain the equipment. Part of CETA's responsibility is to make sure the equipment is operational. It's not equipment that needs a lot of servicing, but whenever there is a problem, CETA is there to get the equipment fixed, swap out components or whatever is needed to keep the equipment operational. As of now, I mean, we project that we will be doing about 200 machines this year, and we have a place for all of them. So there really isn't an issue with raising money before there's demand for the machine. There's demand for the machine, going out at least for at least a couple of years, we think. Originally we were saying the demand was for 500 machines. Now we're talking about 2,000 and more, because of all these other uses for them as well. So I hope that answered that question. What else do you have, Josh? Nothing else?
Oh, I'm sorry, I was on mute. Yes, sir. There's some questions regarding Roy and CETA, and would Roy be available to jump on a webinar with some investors is one of the questions, as well as who on the CETA team is running their daily operations, the scientific research, and that's
Okay.
about it.
Well, as far as getting Roy on a webinar, I haven't done that yet. I can check and see what's going on. I know he was really busy negotiating these coal contracts with the coal mine people, and he was really busy over the last 3 months. So I will see if he can come on at some point and answer some questions. But if you have questions for him, you can submit them as an email, and I'll get answers for you if I can. As far as the CETA team, I'm going to talk about them at the end of the presentation. They're at the back of the slideshow. So what did I miss, Josh?
I think that was about it.
Yeah, I'm going to talk more about the team at the end, but yeah,
Okay.
they have CETA has a plant in Fairfield. They are building. They're building out. They bought additional property so they can expand their coal operation there. They basically have a team on site. They built a new laboratory on site so they can get their test results back faster, and so they can keep their projects moving along a little bit quicker. So there's a lot of improvements that are going on. I hadn't been there in about a year and a half, and I was amazed by how much more is going on at the plant. I don't know that the team has increased. I think they've hired a few laboratory people and scientists, but I think the main team is pretty much the same. So let me go through the next section here, and then I'll hope to get to the rest of that question at the end.
Yes,
so
sir.
what you're seeing here is the storage tanks for the CETA solvent. The CETA solvent then goes up into the spraying tube and is sprayed across the gas stream. As the gas stream cycles through these towers, it basically pulls the CO2 out, and then there's dryers and separators. And then you see finally there's a tank for the solvent, and there's moisture knockout for the gas, and then the gas goes into either barrels storage or another pipeline from there. Obviously this is not set up on a well. This is just set up for display at the plant, but you get the idea of how this is operating. This is some of the equipment in the fabrication shops, and there you can see that this is the inner components are welded titanium tubing. So this is actually the part of the equipment that eventually, when those welds start to leak, that's when the equipment will no longer be serviceable. Most of the other components are, valves and different tanks and things like that. So those types of things are easily replaced and they're inexpensive. This is probably 1/3 of the cost of the equipment. So if this equipment were to be refurbished in 15 years, this is what would get replaced, this titanium tubing. Again, the CETA solvent, this is the components for all you chemistry guys. If this is useful to you, obviously you can get this on the recording. What you're looking at here is one of the CETA distillation units. I think they have like 10 of these on the main plant, and then they have another 17 built on a facility off this site. And they are in the middle of clearing a field to put another 20 or so coal units on there. What is the way this unit works? Basically the coal goes into these feeder bins. It gets conveyed through this heating chamber, and there are I guess pipes to capture the steam and vapor coming off, which condenses into the liquids that eventually form the CETA solvent and a heavy sweet crude oil, which is pharmaceutical grade. So with this, they sell the components and byproducts. They can sell the gas, they can sell the oil, the solvent. And when I say gas, I mean the nitrogen and hydrogen gas. And also the coal light, which is a high BTU coal that has at least twice the BTUs, and it burns clean. So you can see here from 1 ton of raw coal, they can get about 900 pounds of coal light. They can get CETA solvent and oil, and they can get syngas, which is a mixture of hydrogen and nitrogen gas. So now we'll get into a little bit of the financial stuff. Are there any questions on the plant or the equipment? Do you see anything in the chat regarding that?
Yes, absolutely, there is. So environmental concerns with the solvent itself.
Okay, the
Are there
solvent
any?
is not considered a hazmat material, doesn't have a hazmat rating, so you don't even need to take any precautions if you're transporting it. So you could spill it and you don't need to clean it up. It's not a toxic substance.
Okay. As for the technology, who is the competition for the technology?
Well, this equipment has been patented. The coal has been patented, the solvent has been patented, and the CO2 scrubbers have a patent pending, which means that you can have up to 20 years without anybody being able to copy your patent. So I look at it this way. This equipment is being used in such a small part of the market that if somebody wanted to come up with something competitive and they came to this market to use it, it wouldn't make any sense. They could be in a completely different part of the country, say Oklahoma or Louisiana, and they could be doing the same kind of thing with a different kind of equipment, and it wouldn't have any impact on what we're doing because, I mean, we're just such a small piece of the pie right now. So, despite that, in 3.5 years, I have heard nothing about anything competitive that's out there. I mean, you hear about these carbon capture projects, but they're really not doing the same thing as what we are. I know there's an X Prize for carbon capture directly out of the air, but that's not what we do. There's what are the different techniques of carbon dioxide sequestration and storage? That's part of what we do, but that's not the whole piece of what we do. So to my knowledge, there's nobody else out there that's doing this for the large oil companies where they're cleaning their gas at the site of the well. And that's the other piece. This is the only portable system that's out there as well. So I think that
All
covers
right.
it.
Absolutely. And there are quite a few questions regarding the equipment itself. What happened when a machine goes down or it breaks? Is there a warranty? Does that affect the cash flow of distributions if there is a leak or something of that nature?
Okay, so again, I told you that CETA maintains the equipment. Their role as operator, is to make sure the equipment is functioning. So they do have spare equipment, so they can swap out parts and components or the whole piece of equipment if they have to. So we may be down for a couple of days, which may cost a couple $1,000s in revenue, but generally speaking, it's CETA's job to get us up and running as quickly as possible. And I'm showing you the waterfall split here. This is how CETA gets compensated. Basically, we split the fund 65% to us, and 35% to CETA until we've received 1.5 times the investment. And then it drops to 50% until we've received twice our original investment. And then it finally, after we get twice our money back, then CETA's finally getting the lion's share, the 65%. And so it is in their interest to keep this going because, if we're not making our 65%, they're not making their 35. So, and that is definitely part of it. As far as warranty goes, it's like it's CETA's equipment and they're getting compensated to operate it. So they're incentivized to keep it working. So I'm not sure it really needs to have a warranty because CETA's the one that's operating it. So they're gonna essentially, it's an automatic warranty that if they're not, operating it, then they're not honoring the warranty. So, and they're not getting paid. So they're definitely aligned to keep the equipment in working order. And the good news is it's not like it's not really mechanical equipment. It's it's a bunch of tubes and sprays and things like that. So there's nothing really, not a lot of moving parts to break. All right, Josh?
Yes, sir.
I was able to tie in that slide with that question. That was kind of cool.
I like that a lot. I did.
Yeah, that was So anything else in that realm?
I honestly think you answered a lot of the questions that were regarding the equipment.
Okay. All right, very good. So now we're discussing two different funds today. And I think I might only have the one pro forma here. What I'll do is to get the pro formas for both of these funds, we have a link to the portal in Appfolio, and you can download the documents and business plans there along with the pro formas. I'm going to briefly go over the pro forma here of this is the shares fund, which is the leveraged fund. And that's the fund where you invest 100 grand. You sign a note for the equal amount of your loan. So we'd be borrowing 100 grand in your name, and you'd be signing for that liability to be a general partner. And then basically the return is based on that $200,000 of the investment. So in year one, because of the 80% bonus depreciation this year, as opposed to the 100 last year, it used to be that you could take a 2 times bonus depreciation. This year, it's going to be 168% tax deduction. And I've got a table later on that'll give you some clarity on that. We're going to be taking a 50% loan out on the equipment package at 8.5% with a 3-year term. And that loan is with CETA. So again, CETA's interest is aligned with keeping the income coming in so that we can pay this loan off and that we get our revenue share. So what we're buying in the 6, help me out here, John. Which one is the 6? The CC shares 6 fund, CC6.
Right.
I'm sorry for the confusing names, but they developed over time. And so the CC6 shares fund involves 16 pipeline equipment, pipeline shares. The cost of each piece of equipment is $1.725 million. The revenue coming out of all 16 machines is about 18 million a year for the first 2 years, and then it drops down via the waterfall. The loan repayment happens over 3 years with about 5 million a year going to pay back the loans. That leaves a cash flow that covers the investors, the $5 million, and then the operators split the rest. We have a predictable preferred $10,000 a quarter, and it pays out for 7 years. And the return on that is cash on cash of 40%, but the average annual return is 25.7%. So you get a total of $280,000 back on a $100,000 investment, and that 280 includes the initial 100 that you put in. So there's no return of 100 grand after you get that 280. It's just 280. Okay. These are the bonus depreciation charts. Before I get into that, let me mention that the leveraged fund is the one I just showed you. And then there is an unleveraged version, which does not cut off at 7 years, and you own basically a percentage of the fund. And so every payment that comes in on the non-leveraged, you will get a percentage of whatever that payment is, representing your shares. So I will take questions about that later on. So let's talk about the bonus depreciation. So you see 2 tables here, the leveraged fund and the non-leveraged fund. For the leveraged fund, the investment is 100K, and then the loan is 100K. So that allows you to depreciate that full 200K worth of the equipment cost at 80% plus the 20% of, the 20% of the first year. So you see in this chart, there's year 1, you can deduct 20% of the remaining depreciation after the bonus is taken. Then in year 2, you're deducting, or you get 32%, then 19, then 11, then 11, then 5. Over here, the mid-quarter convention, this will apply to any funds that we do in the 4th quarter. So it's just a different schedule of percentages because it's late in the year. We don't take the whole 20%. We only take 5% in that first year. So if you take the 80% bonus plus the 5%, you get 162. And then you can see you can deduct going out 6 years. Okay. And in the non-leveraged fund, it's the same kind of numbers, but we have a 200K share minimum over in that fund so that the pro formas are somewhat comparable. So you can kind of compare apples to apples. All right. I'm going to stop there for a second and see if there's any questions.
Eric,
Yes.
go back 1 slide. One of the things that I'll explain to people is this, because they get confused. They're seeing a 40% year over year return, but the average annual return is 25.7. The reason why, again, Eric explained this, but I'm just going to color it in a little bit. You're getting your $100,000 back. So one of the ways to look at that is each $10,000 payment, roughly 35.5% of that is principal, and the other 65% of it is interest. That 25.7 is that 65% interest. So that's why you see the disparity, 20% and 25.7. 25.7 is the interest you're getting, and because you're getting the principal back, it is a 40% cash on cash that you're seeing. So that's just that may have confused somebody. I'm getting 40% every year. How come the average annual return's 25.7? The 40% has your principal in it as well. All right.
Right. Yeah, I mean, the cash on cash just gives you an idea of how much cash flow you get for the investment amount. But when it cuts off at 7 years, then you have to calculate the average return totally differently. Basically, what I did to calculate the 25.7 is you take the 280 total, you subtract your initial investment, so your return over 7 years is 180. And so you divide that by 7 and you figure out what that return is based on the investment. And it turns out to be 25.7. So just saying it a couple different ways. Josh, were there questions on the bonus depreciation?
Yeah. All right. So is this fund depreciation, the leverage fund, similar to previous funds like CC3? We were told we could take $200,000 depreciation in year one off of the 100,000 investment. Here
Yes.
it's showing 168 or 168% deduction in year one.
That's correct. So yeah, instead of 200, you get 168, and then you got to spread the rest of it out over the 6 years. So you're still getting the whole depreciation. So that's the good news. The other good news is that the leveraged fund, you basically are paying taxes on the income from this fund. And when you have the loan repayments made, you're not getting that income, but it's still considered income. We call it the phantom income in this deal. So as you're paying back that $100,000 over 3 years, each year you're getting a tax. You're getting a tax on $33,333 that you don't get in income. And so what's nice is that income that you continue to get in the subsequent years, or that bonus, that additional depreciation allows you to offset some of that in those years. Whereas if you used it all up in the first year, you just don't have anything to offset that tax with. Okay, I hope that makes sense.
Yes, sir.
And I
Here's
also snuck in the concept of the phantom income. So hopefully everybody picked up on that too.
You are. Absolutely. Okay, here's a good question that's got a few likes behind it. Why put loans in each individual investor's name? I've never seen that before in a private placement.
Okay, so here's the thing. Initially, when we did this, we were going to have one loan that everybody signed for, but that meant you were liable for the whole loan. Each investor that signed that loan would be potentially liable for the whole thing. So rather than sign for the whole loan, what we do is we have the investor just sign a liability or an agreement that they're liable for just the portion of that loan that they are investing. So essentially, I personally end up signing the big loan, and then everybody else signs a liability for their amount of the investment. So you're not really signing for an individual $100,000 loan. You're just signing on that, you're taking liability for that 100,000. And the reason you need to do that is in order to be a general partner, you have to be liable for all risk and debt. So if we don't have you sign that, then you're not eligible for a W-2 deduction. If you don't sign that liability agreement, then you only get passive income deductions on this. So hopefully that helps.
All right, thank you. Here's another question. Is the only benefit of leverage fund the extra depreciation in year one and consistent quarterly payouts? Could you please talk about why you like the non-leveraged investments? Are quarterly payouts based on percentages, and are they not capped?
Okay, so the non-leveraged fund does not have a 7-year cutoff. You are getting a percentage payment of all our payments, but initially your first payment is probably going to be higher than the equivalent payment in the other fund, but it's going to level out and be a little bit lower in the later years. So, it's going to be a little more than 10,000 in year one for a $200,000 investment. It's going to start dropping off through year 3, and then it's going to level off below the 10,000. So, from an equivalent standpoint, it's a little less payout during that first 7 years, but then it extends the payout out to potentially 15 years. So we did that because you didn't get that extra bonus depreciation on the front end. So, and what we're finding is that basically at the end of the loan payoff, you've paid the same amount of taxes on both of these deals. There's no free lunch. You don't get bonus depreciation that you don't end up, having to pay. I think that they both serve a different purpose. I think for people that don't have a huge tax liability in a specific year, the non-leveraged fund may be better. But if you have a business sale or something where you need to eat up a lot of, tax liability in 1 year, if your accountant, can get a bigger chunk like this, a 2x or a 1.6x chunk, then they can probably manipulate the amount of taxes you're going to go much more effectively. And then hopefully in subsequent years, when you're not making as much, then you can maybe, deal with the phantom income in a year when you're not making as much, income. So again, the accountants can tell you, whether they can take advantage of that excess leverage in the first couple of years. And like I said, most of the people that are taking advantage of that are either making it just a huge high W-2 income, and maybe it's not going to be a consistent income at that level, or they're selling a business at that time, or they're doing some kind of Roth conversion, or sold a building, or something like that. So hopefully I answered that question.
Here is kind of a follow-up question in returns of the loans and things like that. So how is CETA able to support such large loans for the investment? Are there any concerns for excess leverage on the business if things don't perform to the pro forma?
Well, we've kind of structured the loans so that a lot of them are paying off inside of a year. And so we're basically recycling the same capital. We have a couple that go out 3 years, but nothing goes beyond 3 years. And so, CETA is very good at managing their company in terms of debt. They carry no debt. So, basically, I think what's happening with some of this money is that Roy is investing some of his foundation money at 8%, 8.5%, and then that becomes CETA stock, and it becomes loans on their books and things like that. So it actually makes their balance sheet and their books look good for the eventual day when they consider going public, if they ever do. So it works pretty well when your company's debt free and you're making millions of dollars every year. There's plenty of money to do this. And that's part of the reason we created the non-leveraged funds, is that we were reaching a point where CETA couldn't cover all the leveraged funds that we were starting to build. So the non-leveraged funds now are probably going to increase in percentage. We'll probably have a similar number of leveraged loans every year, but you'll probably see the non-leveraged equipment, probably that will increase in percentage. Okay. Anything else?
Sir, kind of looking, the majority of the questions that I have on here are referencing back to the equipment and mainly the solvent. So I think we're good to continue on, sir.
All right. So yeah, if we missed any of your questions on that stuff, if you could just punch them in again so that they're kind of at the end of Josh's list, and we can see, if there's still any questions remaining about that. So on this slide, we're talking about the different tax benefits. So as I said, the bonus depreciation allows for 84% deduction this year in the first 3 quarters, and then 81%, I think, in the final. However, with the 50% leverage, we double that. So we get to 168. All the expenses and fees are covered by the fund in order to pass all of the benefits on to the investors. So if we did what normal funds do and charged fees for different things, all those fees would get subtracted from the amount that you could deduct as bonus depreciation. So because of that, we take all of our revenue comes in after the investors and the loan get paid. So we get 0 unless you've gotten your full payment and been paid off fully. Okay. So the only thing we have to offset the fund expenses are really the depletion allowance of 15%. And the weird thing about that is it's not really apparent, with all the other deductions that we do. You really don't necessarily see this depletion allowance until later years of the fund, when some of those other things go away. They kind of get buried in it. So I haven't actually really seen the 15% bonus or depletion allowances yet. And at some point I'll get a good explanation from Tim as to why I don't see those yet. But I think it has to do with the fact that you take all the other deductions first, and then you need to have income or basis to be able to take this. And we won't have that basis until we've gotten a little further into taking all the deductions from this fund. So I included this section for the accountants. So basically this is not really, an opinion letter or anything like that. It just references some of the sections of the tax code where we derive our theory as to why this is a working interest in oil and gas, and why we'll be able to deduct it as W-2 income. And it also discusses the fact that once you start out as an active income, it remains active income even after a switch to an LP. A lot of people ask that question, is when it switches in the first year from a GP where you have liability in the deal to a limited liability, the nature of the income is still active income. So that is something that comes up a lot. So you don't turn it into passive income once you turn it into an LP, according to these regulations. All right. So I don't spend a whole lot of time on the risk mitigation. You can certainly ask questions about it. But from the standpoint of political risk, I mean, everybody was so worried about the Biden administration taking over and how this would become not as friendly to us, and it absolutely has made it even better, I think. I think the fact that this is kind of a green energy project and one of the cheaper ways to produce oil makes it something that is not going to become unpopular. At the time we started these, Roy was involved in the Department of Energy. He was appointed to the Intellectual Properties Committee by Rick Perry, and he was part of the Trump administration. He did not carry on with the Biden administration, but they did actually interview him. So he was one of the few people that they were willing to keep. So we talk about regulatory risk. Again, we don't see regulations going against what we're doing because we are doing something that's rather green. And it's also in the interest of the oil company to produce oil in wells that are already drilled, because they don't have the cost and the risk of drilling new wells, and they basically are getting oil from wells that they already paid the big expenses for. So it is actually the low-hanging fruit for them, believe it or not. Weather risk, obviously, weather is an issue when the temperature gets below freezing. Most of the pumps that are necessary to operate our equipment are shut down, and therefore, if we have freezing weather in Texas, Western Texas, El Paso, we might have a couple days of shutdown per year. And that means that the first quarter revenue is usually a little bit less than the rest of the revenue. And the other issue is mobility of the people servicing the equipment. If they can't access the oil fields, the roads aren't clear, then they can't get in there to replenish solvents. We talked about patents and trademarks, coal supplies, to make sure we have enough solvent. According to Roy, they have leases or own 9 different coal mines, and they have a 96-year supply of coal. They also have transport contracts to get the coal to the plant. And so if they can't get it through normal channels, they do have private channels to get it to their plant. Competition, we talked about. Maintaining costs and advantages of patents. Yeah, we kind of talked about all that, market risk and stuff. So obviously CETA has a strategy of being debt free. They want to make equipment in the USA and use USA products. They want a company that takes advantage of environment. Environmentally, they want to improve things as opposed to making the environment worse. And as you can kind of see with their equipment and their projects, they actually do improve the environment. And they don't want to operate with borrowing from governments or grants or any kind of technology or any kind of subsidies that some of the solar companies and so forth, they need that to be profitable, and they don't want to do that. So in spite of the 3 or 4 things I already talked about, there's 15 different industries listed here that could utilize our equipment, maybe not as profitably as the oil industry, but we would not be completely shut down if the oil industry went away, which it's not likely to do. I think everybody likes their plastics and cosmetics and their medications too much to let natural gas go away. These are industries that would make use of the CO2 that we're pulling out of the oil and gas. So they've actually been approached by believe it or not, marijuana growers for the CO2 that they need for the marijuana. I think they've been contacted by SpaceX for the different gases. So that just shows some redundancy of uses for our equipment. And so I told you I would go over the team. We have here Roy Hill, and his second in command is Michelle Moore. Michelle's been with Roy for 32 years, and she knows she knows what's going on as much as Roy does. Obviously Roy's been in the oil business for years and years and has a lot of connections. So, losing Roy would be a big loss, but Michelle knows how to run the company, and she's the one that's probably doing most of the day-to-day operations anyway, while Roy's out, schmoozing and making deals. Obviously he's got, his executive team, and, they manage not only the plant and the, the sales of the byproducts and everything. Tracy Thompson, he's the plant manager, and he just makes sure the coal plant's running and everybody's got their job going. And I believe they've probably added a science officer as well. This is the office team. They basically are the ones that calculate our payout statements and do the paperwork for us. And then these guys are like field supervisors, and so they manage day-to-day plant operations. And again, introducing Roy and myself, and then our attorney who drew up all the documents is Mauricio Raould and Tim Gertz. And I'll mention that Mauricio has a podcast, and I think we sent out a link to it today. And on that podcast, Mauricio's associate Bethany LaFlamme interviewed Tim Gertz for about 42 minutes on all the tax benefits regarding our deal. So it is one of the best treatments of that information that I've heard, and Tim explains a lot of the things that I talked about today, but he is much more eloquent about it. So I encourage you to listen to that if you want to learn more about the tax benefits and all the little nuances of that. And that is the end of the presentation. I probably have a few more things that'll come up with the questions. So let's go back to Josh and see what the questions are.
All right. What is the ratio between the distillation unit and the pipeline unit?
In other words, how many coal units you need to support, how many coal units you need to support a pipeline unit? The answer to that is, initially we thought it was closer to 1-to-1, but over time, what we've realized is that the solvent can be cycled more than once. So it kind of runs in the background until it's saturated, and then it also can be run through the well multiple times as well. So I think the answer now is 3.5 pipelines can be supported by one coal unit. And the other thing I can say to that is CETA is well aware of the demands of the solvent, and they're planning ahead well enough so that they don't outstrip their supply. And that's why they're building the coal units like crazy right now. Next question.
What is the operating cost of a pipeline unit and the chemical that is used to strip the CO2? And how often does that need to be replaced?
Okay, so if you're talking about the cost to our fund, It is zero. We don't pay anything to run this. We get revenue from the deal. So, I don't write a check for anything that revolves around, processing gas or running our equipment. Basically, what comes out of the equipment usage is that we get a revenue stream and no expenses. So the expenses fall to CETA when they're repairing things, and to the oil company for their operation of the equipment. Now, CETA does not run the equipment day to day. The oil companies, once it's delivered and set up, basically they're the ones that run it, and any expenses that they have to run it are theirs. They basically pay us revenue based on the oil that's produced because of the various steps of our process. So there was a second part to that question. I'm trying to remember exactly what it was.
The second part of the question, oh goodness, where did it go? I'm sorry.
I mean, the question was asking what are our expenses, and the answer is none. So I don't know if the second part of the question was a follow-up.
It was a follow-up question. Just curious on how many times we have to go and refill the wells with solvent.
Oh, we don't have to worry about that. Our fund doesn't do anything like that. Our fund basically owns the equipment and collects revenue from the equipment. We don't operate. So, however they, like I said, they basically they decide where they're going to pump the solvent. If they have a well that's not producing as much, they can move it to a well that produces more. So there's a lot of flexibility there, and I don't honestly have the details as to how much they use and how often, and that's just not part of what we have to do.
Oh, I think that answered quite a few questions, honestly. It seems that more people are curious to know a little bit more about the OS05 fund, the non-leveraged fund.
Okay. I might be
referring
able
to cash flow and
Yeah,
how the returns are.
I have to look for the pro forma on that and see if I can display that easily. So give me a second to see if I can pull that up. Actually, you know what? I will go to the business plan. Are you seeing my screen, what I'm doing, or are you just?
No, sir.
I
We're
guess
just
I'm not
seeing
sharing.
you.
I'm not sharing right now, correct?
No, sir.
Okay, good. All right, give me a second to find the OS05 business plan.
While Eric's looking for that, I'll mention a few things that I've mentioned to a lot of you I've spoken with, some I haven't. One of the things, I'm an investor in this multiple times myself. And as far as de-risking, I look within the first 2 years of being in this fund, you have your capital back. Now, that being said, if there's a 3-year note on your particular fund, yeah, there is the liability for the last third of that note, but it's a quick return of capital. When I look at the leverage versus the non-leveraged, if you have a smaller amount of cash, you can use the leverage fund to bolster your tax deduction. And so I look at that when I'm trying to move money from my traditional to my Roth. I can double the amount that I can move by using the leveraged fund. The non-leveraged fund, I look at more as there is no note to pay off. So the payout comes back quicker to you and creates that cash flow right up front. So if that fits your need better. So we all have different needs in and of this, or different cash situations. Eric talked about the fact of using a leveraged fund, if you've got something you couldn't find, you know, a replacement property, or you sold the business, or whatever it may be, IW2 and so on. There's a number of uses for it that people have used, but there's a very practical sense to using this. Yeah, dig into the background on different things. Like somebody asked Eric, do any of the CETA employees invest in our funds? So I can't answer that in particular, but I don't know how that would even be relevant. So if you're thinking that they don't believe in their own product, I don't think they'd be working there. So
No, they own stock in CETA. They don't invest in our fund.
all right.
And you know, the average employee there is not necessarily a well-off investor. You know, they're guys that are working at a plant. So, I mean, there's office people and there's plant people, and then there's maybe one or two executives. So yeah, the answer is no, they don't invest, but you know, I certainly do, and John certainly does, and you know, we've definitely got more in than anybody else does. So, can you see the pro forma there now?
Yes, sir.
Okay. So this pro forma is based on 10 units, each unit being 1,700,000 or 1.725 million is the cost. And so the revenue from 10 machines works out to about 10 million. There's no loan on this machine. Basically, the revenue is split 25 to the fund and 75 to the investors. So out of that 10 million, 8 million goes to the investors and to the fund. The a share of $200,000 would return about 93,000, or yeah, 93,000 in year one. So that's, what is that, a quarter? That's you know, 24 and change in a quarter, 23,000 a quarter. And then it drops to a little under 20 a quarter. And then it would drop to about what, 15, something like that, maybe 12,000 a quarter. Okay. And so a $200,000 investment versus $100,000, and you can kind of compare the two a little bit there. But at the end of 7 years, it doesn't stop. And so instead of 280, you end up with about 867,000 over 15 years. So in the long run, if you're patient, this is going to be worth more money to you. But in the short run, you may get a tax advantage that will save you a lot of money that you never have to pay to Uncle Sam. So I think there's good arguments for both. So those are available at the website or the portal. And if you don't have links to those, then make sure you email us and we'll try to get links to you guys. Any other questions?
Oh, there are a bunch of questions.
Okay.
All right. Just a quick question. What was the name of Mauricio's podcast again?
I didn't give it.
Oh, got you on that one.
I didn't give it. We sent out an email today. I got that email today. I don't know if that went out to the general mailing list, but I don't know if I can look it up real quick or not. I'm sorry, I'm not seeing it. If anybody knows what it is, they can put it in the chat.
All right. What is the link to the portal? I'll get you taken care of.
Okay, I'm seeing, so I'm looking at the Q&A now. Are you deleting as you go?
Yes, sir. Yes,
Okay.
sir. So far, we've answered 49 questions.
Should I start walking through these questions?
Absolutely.
Okay. All right. So what's stopping Exxon from building this tech on their own? Well, one thing, they don't have the patents. The other is that Exxon's an oil company. They don't build equipment. They operate oil operations. Okay. So next question. Thanks for the IRA answer. Are there tax benefits, deductions for 401k funds that require a tax penalty to withdraw? All right. So if you withdraw money from a 401k and incur a penalty, I believe you could use this to offset the penalty. You could take that money invested in this, and the tax savings would probably cover the penalty. I don't know if that's true or not. You'd have to ask. But the way I know that that works potentially is that during the COVID crisis, the CARES Act allowed for a loan from your 401ks and IRAs of $100,000. And there was no penalty for taking that loan out. And you had to pay that back in 3 years. And so what a lot of people did in those days they would take the loan out of their IRA or 401k. They would invest in this deal so they get this big tax benefit. And because of the payout being so quick, within a year and a half, they could pay it back. And then for a year and a half, they could double dip on that investment. So if you pull money out of a 401k and do a rollover, you incur a tax. If you take money outside of the IRA and invest it in this, then you have a bonus depreciation that you can use to offset that rollover tax. So those are the quick comments I have about that. It's definitely not an area of expertise, but that's what I've seen done with it. We have next question. Any updates from Freedom Impact for the database and performance data across all the various units that can be shared? The answer is we are starting the data entry on that tomorrow. I have some people working on the data entry. Don't know how long it'll take, but what I can tell you about the data is that my sense of it is I see all the machine reports that, how much solvent is being used and how many days the equipment's running. And there's definitely a narrow range that all the equipment's operating in. The answer is that, each equipment does a different amount every time. So it's not, exactly the same amount for every machine or every quarter for each machine. So depending on how you add the funds up or add the machines up, you're going to get different ranges, but it's operating on pretty much the same range for the whole 3 years that we've been looking at it. So are there any installed in the field photos that you can share? I'm supposedly getting some. Don't know when that's going to happen. I was told 2 weeks ago that they were installing a couple and they were going to try to take some pictures when they did that. Are they using stripped CO2 to do CO2 fracs or more an enhanced recovery technique? It's really, I think they're using mostly the enhanced oil recovery technique. They may be using some other techniques as well, but that's as much as I know about it. Is it possible to invest passively from the beginning if I'd rather have income? as passive rather than active. Let's put it this way, nobody's doing that. The only way you do that is if you invest as an LLC and then it becomes passive, but all the other stuff applies. Let's see. Yeah, I'm not sure. I'm not sure why you don't want to take advantage of that, but whatever. Let's see. Confirm future income is classified as K1 as active and therefore can't be offset with suspended passive losses. That's an accountant question. I can't confirm or deny any of the accounting information. I can just bring up the issues and then you can discuss that with your advisors. So yeah, we can't confirm any of that kind of stuff. But we've been told that, if it starts out as passive income, the nature of the income can't change just because you're changing to an LP. For IP risk, can you provide patent application numbers for the CETASolve or CO2 machines since can't find it for them? Somebody's found it. I haven't, it's only come up once or twice and I never really got to the point where I went and looked at the patents myself. So I'm not sure I can give you the patent numbers, but it is available somewhere because a few people have found it. And I'm sorry I don't have a better answer for that. I guess sometime when I'm there, I'll try to get those numbers. How do carbon credits figure into our operations? They don't. We're not involved with carbon credits. Carbon credits can be used by Exxon or the oil companies if they choose. For us, it makes no sense to get involved with it because our costs of calculating it would be offset by what we make from it. So it's not worth it. Can you discuss risk listed in the new documents with unable to independently verify critical information? What has Freedom Impact done for diligence on your visits to CETA? So we basically added some language there because when we started this, there was no data to look at. There was no, none of this information was available for how the oil companies, paid CETA. So the deal is that CETA is in multi-project contracts with the major oil companies. And so the revenue that they get is kind of bundled. And because of the non-disclosures and because of the way these things are calculated, there's no easy way to show us exactly how that revenue is being distributed to us. And we've looked at this with CETA's attorneys, and there's really no way for us to get a good look at that information without violating that non-disclosure. So if that is an issue for you, then this is not your fund. That is basically the disclosed risk that we're telling you about. Read all of those and make sure you're comfortable taking that risk. We have 3.5 years of track record to back up that everything's been working exactly the way they said it would, and that we don't have any reason to believe there's anything bad going on, but we don't have access to that, and we're letting you know that right up front. So let's see. Did I understand early on that Roth funds are subject to UV? Yes, because it's an active business. And you can talk to your accountant about it. I don't recommend doing it with an IRA money. We had a fund set up for that. And we kind of engineered it to be optimal, but I don't think the way we're doing these funds that it's going to be optimal for you. So I don't think it's the greatest idea. Across all funds taken in by Freedom Impact so far, the 260 AUM, levered or unlevered, listed on the website, how much has been paid out in distributions to investors thus far? think I might have seen the number at 39 million.
I
And
would
that,
say that's pretty close.
I think that's what I saw on Appfolio. Now, just remember that number, there's a phantom payout that pays back the loans. So I would say we paid back probably at least 20 million in loans as well. So I believe the revenue is closer to 60 million total, and then some of that revenue goes to pay off the loans. Okay, does CETA partner with any other investment groups or institutions? CETA is doing the carbon dioxide exclusively through Freedom Impact. The coal deal is somewhat managed by Dave Zook, a real asset investor, but I think some of those machines are also financed in other ways through private concerns.
All right, and then it seems like a bunch of people were very nice and were throwing up links to the podcast and everything to everybody. I greatly appreciate you for doing that.
Yes, thanks a lot.
If we scroll down to the bottom, Eric, there are a couple more questions down there.
Okay.
Do you have a recommendation for a specific type of CPA to look for 2024 to take advantage of these active losses?
Okay, so I mean the CPAs that are, you know, familiar with the real estate and bonus depreciation and investing, those are the guys that seem to know this best. I mean, I mentioned Tim Gertz is our accountant, but you know, there's a couple of good accountants that have invested with us and have referred a lot of their clients. So if you need some names, you know, we can probably give you a couple of different names of people that that we've seen that can handle these kind of things. The active losses are challenging because there aren't too many things where you can take active income deductions. So, you know, that's one of the things we're starting to get into some real estate investments, and we can't completely offset things, but we can basically, there's some real estate strategies that probably create more passive income from the income that we get from the active project here. So I'll just leave it at that. What is the breakdown of levered versus unlevered for total capital raised so far? Let's see. We did 5 machines in the first non-leveraged fund. And then we did 10. Oh no, we did, what did we do, John? Did we do 3, then 5, then 10?
Yeah, I'll take a look.
Um,
And yeah, I think 3 and 5, 8, 15, or 18. Yeah, this probably takes us up to 28 with this fund. And that's 28 out of the 170 machines. And then actually the first 2 funds were non-leveraged as well. Jared, let's see. If I end up investing in a lot of these funds, I'll end up raising the amount of active income every year, and I'd like some passive income. So that's why I'm interested in passive to begin with creating passive cash flow. Again, I think you might want to talk to an accountant if they think that's a good idea. That can be fine. What we're looking at with the real estate deal is that, you know, this active income on this fund is kind of an accelerator for most people. Most people are not finding real estate funds that pay 25%. And so when you make 25% on this fund for a couple of years, you could buy a lot more real estate with that active income. So I kind of look at this like I look at my W-2 job. In order to get out of my W-2 job and get into passive investing, I had to pay the tax on the W-2 income and invest in passive assets. And so this is kind of the same way. This, you're going to build up active income really quickly with this compared to other investments. And then as you take that income and invest it into passive after you pay the tax on it, you're going to have more passive income. So, that's kind of what we're looking at. And the way we're kind of approaching it is we're trying to figure out what are the techniques in real estate investing that offer the largest amount of bonus depreciation on the same amount of capital. And we kind of think that, investing in an infinite return model where you get cash out refinances and then get to reinvest that money and get more depreciation from the same capital. That's what we're looking for. And if somebody has good source for that, that would be awesome. Can you chat about Exxon hydrogen plant opportunity as it seems to fit more the green wave? I don't really know what to say. I mean, hydrogen plant is just converting the energy in a different way. It's another place where we can use our equipment, and I don't know that it's better or worse than any other use for the equipment. I'm not qualified to make that judgment, I guess. Is the 260 million total capital taken in by Freedom Impact, or that mostly levered? Any concerns other will flood into this area with the given tax benefits and returns? So obviously, I kind of explained the amount of leverage is, take the 28 machines out, and then the rest of it's about 50% leveraged. So, the 260 million is basically the value of all the equipment that we operate, which includes the loan. We've paid off the loans on probably 8 or 9 funds already. And as far as others flooding into this area, I don't see them yet. And we've got patents that are going to carry on for another 17, 18 years, maybe, at least on the equipment.
And I definitely think it's important to note that, we have paid off 8 or 9 loans already, and we have only been doing this for a little over 3 years. So that's pretty fantastic.
Yeah, well, some of them were only 1 year long, and we continue to do 1 year loans. So that's why we're up to 8 or 9 funds that are paid off. Once you invest, the income is active income for the life of the investment, even if the ownership is transferred to a person or to an LLC. Yeah, the nature of the income in the first year remains the same throughout the investment. So everybody wants to change it, but I wish you could. I don't think you can. But get your accountant's opinion. I mean, you can, I can't tell you how to file your taxes. That's up to you guys. So can you clarify the 10K phantom payments quarterly in future years? Is that considered active income similar to W-2 yearly? I don't understand the question the way it's asked. I'm going to say there's no 10K phantom payments at all. The phantom income is basically the money that CETA gets for the loan repayment. Okay, so if you loaned $100,000 on a 3-year basis to CETA, then each year you would pay back $33,333 to CETA. And so you would be taxed on that amount, besides the fact that you weren't paid that money. So you'd owe tax on the 33, but you would not have been paid the 33. So that tax would have to come out of your other income. Okay, so that's what that's all about. And I don't remember what the rest of that question was. I hope I answered it. Can you describe the impact if someone decided to leverage their own and borrow to fund twice what they put in? And this is actually an interesting concept because a lot of guys do this. So essentially you could invest in the non-leveraged fund and then borrow as much as you invested, and you would essentially have the effect of the leverage. It just would be your own leverage. And so you're paying back the loan to whoever you got it from. So yes, I mean, it works the same way no matter who the leverage comes from. And when we initially put out the non-leveraged fund, we actually were telling people, you know, if you have a credit line or an insurance policy, you know, that has cash value, you could use some of that, and then you would be arbitraging the interest on that to double the amount of the loan or triple even. But I think there's going to, you know, you could borrow, you know, 3 or 4 times and get a 4 times tax or bonus depreciation, but based on 80%, obviously. But I think there's a diminishing return to doing that because of the phantom income, because eventually you got to pay the tax on that. So just be careful if you do that yourself. But you know, I you know, the most I've seen us do it is a 3-to-1 leverage. How much debt then is Freedom Impact on the books given so many loans still active? Well, we basically, you know, you guys have signed for liability. Anybody that's invested with us, they're liable for the amount of their investment. And then I'm basically signed on as the manager of the fund for the loan. So, you know, we basically owe the money to CETA. And, you know, we basically are at 50% leverage or less at any given time. So we own 50% of the equipment that we have leverage on. As far as like dips in performance, as I told you, we get pretty steady performance because we really have, you know, price protection on this thing. You know, as long as it's operating, you know, and nothing, you know, disrupts the whole thing, you know, it's just going to keep going on like it is. So, I mean, I think it would have to be pretty catastrophic for it to change. Since the performance has been so strong, what are CETA's goals moving forward? Why don't they fund themselves or go institutional? Well, they've decided to go debt-free. If they fund these through institutions, they're going to be borrowing money. So as long as they don't have to do that, you know, they're in much better off position when they're loaning money to do these things. You know, at some point where this can't be managed by a company like mine, where there's 2,000 machines and, you know, 50,000 investors, you know, they're going to have to come up with a different model. But as long as, you know, we're getting funding for this from our investors and we can match their demand, we are going to be able to keep doing this. And then once we hit that wall, then we're going to keep managing these until the machines wear out. If you invest March 15th and payout begins September 15th, no. The way it works, it's not 60 days from when you invest. It's the next payout that happens in September after the first full quarter of operation of your equipment. So if your equipment is funded by the end of March, then it should operate for the full quarter of quarter 2. So April, May, and June, and then 60 to 90 days from the end of that quarter, you'll get a payout depending on when it comes in from the oil companies. So we reserve the whole month of September to make the payouts. So it could happen, as early as September 1st. Sometimes we get them, a little bit earlier for some of the funds that have been in existence. But the new funds will certainly be toward the end. So, so if you invest in this batch and we close these out by the end of March, which we should be doing, then your first payout will be sometime in September. And, it could be the end of September, but it probably won't be. It'll probably be more like, the 10th through the 20th, something like that. So please don't ask me if it's coming in, on the 2nd or 3rd, because it very likely will stretch into the month a little bit. All right. Those other syndicators on Mauricio's podcast, do they work for Freedom Impact? Is the deal different depending on the syndicator? Okay, so I have 6 sponsors that offer the same deal as CC6. It's exactly the same for the investors, but they are doing the capital raise and they're signing for the loans. And so they're partnering with me on those funds. So they are partners with Freedom Impact. The deal is the same as our CC6 so that there's no confusion. If there's no spot in one of their funds, we can shift people to funds that have openings, so that if we go to the end of the raise and there are people that still want to get in, we can move them from one to the other, and they are equivalent, I should say. So, but I'm basically a partner in every one of those deals and all of Freedom Impact's deals. So I'm basically responsible for managing all of it and liaison with CETA on all of them. Just to be clear, the tax advantages are only available to invest personally.
LLCs is the follow-up to
Yeah.
that.
Yeah, if you are an LLC, then you would be considered passive in this. And that might go back to answer the question that was asked earlier about passive income. If you invest as an LLC, we're probably going to try to talk you out of it. But if you want it to be passive, that's one way to make it passive, because you're not a GP if you're an LLC. You don't have the liability. Even though you signed the contracts as an LLC, you're not getting the W-2 treatment. So that might answer your question, but you need to talk to your accountant about that. Are there more coal deals to keep up with the CO2 machines? They are building more coal machines as we speak. And they plan on more later in the year. I don't know if Dave Zook's going to raise a fund for those or not. I know he's still talking to Roy about it. They're trying to work out some things. And there's similar issues to what our disclosures were talking about. He's got the same issues. My C Corp can invest leveraged, and profits of the C Corp are greatly minimized. Again, that's an accounting question. I don't really have any comment on that.
All right.
We'll do whatever you want to do, but you're responsible for the result. Am I friends with Dave? Yes, I am. Dave introduced me to Roy at one of his Belize events, and that's the reason I'm involved with this, is because Dave made that connection for us.
Well, sir, you have answered 98 questions this evening. You're on fire.
All right. Well, that's good. Then we got a nice recording that answers a lot of questions, and I don't have to do a live one for another couple of weeks. I think the last one was like a year and a half, 2 years ago. So
that's great.
Yeah, I mean, I guess the good news is the funds have been in high demand and we've been filling them quickly. We've been open for 2 or 3 days now, maybe 4 now. And we're at least 10% in every fund, and we're, I think, 40% in one and 35% in another. So some of those are, sponsor funds and so forth. So, but the two that we have the most shares in available, they're almost 10% full in the first 2 or 3 days. So that's a great response, and I think we've hit a lot more people now. So we are absolutely trying to close these by the end of March, but if you wait that long, you probably will not get in. We basically are holding our positions with the wires, not the signatures. So once you sign your documents, your spot is not held until we receive the wire. And if we receive the wires to the point where we have the fund full, then you will have to wait for the next quarter, and you'll lose about 90 days. So how do we stay up to date with status of fund filling? I don't have a good answer for that. I mean, you can call and email us every day, but that's kind of annoying, to be honest. I'm not gonna, if you see emails from us, we're still trying to fill it. So I'm not sure how else to answer that.
Yeah. Well, sir, I think that is all the questions that we have this evening.
All right, great.
For those of you that are left, if you do need anything, support role, please reach out to me. support@freedomimpacting.com. I will gladly answer any questions, help you through your documents, whatever you folks may need.
Yeah, Josh has been awesome helping everybody get signed up and solving issues. So I just want to tell everybody how much we should be appreciating what Josh does. He has been fabulous. And I know John has been fabulous. He's been fabulous for years.
We appreciate you, sir.
Mr. Wonderful.
All right, everybody. You have a great night. Thanks for coming out, and hope to see you in Appfolio.
All right. Thank you, guys.
All right. I'm going to end the webinar. Good night, everyone.
All right.